Hello, my name is Maurice Washington. I want to welcome everybody to another episode of Executive Talk. Those are here live and those are you watching or listening later on our podcast. Thank you so much for joining us on another episode. In today's segment, we're going to talk about bankruptcies that are on the rise. We're noticing a trend out here, and one thing that we don't want to do is for business owners to fall asleep to this particular trend because bankruptcies is counterintuitive to why you started your business. You started your business to make sure that it flourishes, and also, is able to hit your dreams the way that you had anticipated. One thing that we want to do is address that and figure out a way and a solution out there in the marketplace to figure out a way to actually help uh, minimize these bankruptcies, and also think about something extra that we can do to protect ourselves within our business. So, without further ado, I have Rick Calloway with me, who is a business insurance specialist over there with Acrisure. Rick, how you doing, sir?
Doing just great. Looking forward to a good show. And this is a
Uh,
very interesting topic.
yes, it is. And we also have Joe Nuti. How you doing, Joe?
Hi. Well, thank you so much.
Very good, very good. And Joe, you're with Acrisure also. You're a trade credit. What does that mean?
Trade credit broker, we take care of providing accounts receivable insurance to companies to prevent any bad debt loss that they might have when they sell on
Gotcha,
terms.
gotcha. So within this time frame, with what you do, you've probably seen a lot of different business scenarios in which your services are hitting. Are you seeing that there's a trend in people needing your services a lot more?
We are. There's a lot more inquiries for credit insurance. It costs you nothing to apply, and you can have your top 20 accounts underwritten by the insurance companies in the market to tell you who's a good credit and who's a bad credit, bad, or higher risk, and whether they'll cover those credits. So somebody who's been doing business for a long time might have had changes and might not be the same credit it was when you originally went into it. And we have some trend figures for you.
That's fair. And that's the perfect segue into the question I want to ask you. And this is a perfect opportunity for everybody to understand this. And this one question is, have you noticed an increase in Chapter 11 filings over the past year? And one thing that you provided for me, Joe, is kind of some historical value on some of the trends when it comes to bankruptcy. So go ahead and take us away on what you've seen and what the statistics are saying.
Sure. There's a firm called the American Bankruptcy Institute, which monitors the bankruptcies in the United States. And they submit reports through what they call bankruptcy analysis. And there's several kinds of bankruptcies, 7, 11, 13. So it's just not a Chapter 7, it's also a reorg. So commercial Chapter 7 filings have increased 70% to June 2024 over June of 2023. So now we're close to 1,000 mid-year, a couple months ago. We're close to 1,000 just Chapter 11s. And in 2023, we were at about 600. So it's pretty hefty increase. Now, commercial filings, which includes everything, there's been a 30% increase, meaning that there's almost 3,000 liquidations, Chapter 7, 11, 13, in 2024 versus about 2,000 in June. This is just half a year. June of 2023. So there's some pretty significant increases. And one of the biggest carriers that we go to, just them, and the credit insurance pays more than just bankruptcies. They pay non-payment for any reason. They show, and this is just one carrier, they show a 30% increase in the volume of claims and 11% increase in the dollar amount of claims just to June. So this is 24 over 23. So it's pretty significant hits people are taking.
Gotcha. So, one of these hits, and especially doing business and especially doing trade, because that's exactly what business is. You have your net 30, you have your net 60, you have your net 90. So this is and that's obviously those are payment terms, and everybody knows that that's doing that type of business. Now, in this business, do you feel like those net terms, do you feel like they're creating the gaps when it comes to these bankruptcies, or what are your thoughts?
Well, what we're saying is, of course, interest rates are really high for companies. And not only are interest rates high, the banks are consolidating. So we had a perfect example of a bank said goodbye to a certain level of their customers. And I scrambled to help them find, because I used to be a lender too,
Sure.
to find a replacement. So what we're finding is you have to think about what you're really doing. On a term sales, you're making an unsecured loan to your customer. You're giving them your asset and you're saying, okay, I'll lend you for free. I'm not charging you for 60 days, 30 days, 90 days. Well, what do you think? They're going to use your money instead of borrowing at 7%. So what we're seeing is people are starting to delay. Your customers are delaying their payables, your receivables. So they're getting pushed out. So a 30 isn't a 30 anymore. It's now a 45, and you're spending more time because it's free money to them. Why wouldn't they push you out? Because interest rates are, and if you're not on top of it, it's going to get worse, not better.
And that is true. And it's almost like before, and I want to say pre-COVID times, and I think actually, I don't think it was even specific to pre-COVID. Listen, let me just clear that up real quick. But when it comes to business, when it comes to cash flow, when your cash flow is good, those net 30s, those are good terms. It seems like it makes a lot of sense because cash flow is good on their end. Right. They're receiving their payments from their customers and they're able to pay just fine, right? But all it takes is for things to get messy in the back end, meaning customers aren't paying for that client that you're working with on that net 30 or net 60. And now they start pushing those terms out. Is that typically what's going on behind the scenes?
That's exactly what's going back. In fact, we have a term for it that's an old Cold War term, the domino effect, because you don't know who your customer's customer is.
That's
and
right.
You don't know if they have concentrations. You don't know what. And that could really hurt you because if they don't get paid, they're going to push you out longer. And surprises are the other thing you better watch out for. Look in the paper today, Supermicro, stellar microchip company, their auditor quit and their stock tanked 35%. Whoa. Surprise. I'm not saying they're a risk. I'm saying they weren't yesterday, but they are today. Look at Boeing. Boeing's not going anywhere, okay? But, it's not a blue chip anymore. It's a watch out. And if you have people would say if they had a concentration, I don't care, it's Boeing. That's probably still, but why risk your whole business on something like that? We will help you avoid surprises.
That's exactly it. I like that. Rick wants to weigh in. Rick, what are some of your thoughts on that topic?
As far as the folks getting the credit insurance, is a person that sells multiple lower price things more adversely affected by non-payment, or is the guy that sells 5 big things in a year?
That's a real good question. It depends on the credit insurance fits for both. However, if your margins are tight and you take if your margins are 2% and you take a hit, it's going to cost you $2 million to make up that $50,000 hit. So just to break even. So credit insurance works for both scenarios. They want at least somewhere in the neighborhood of 1 to 5 million. That's kind of the smaller end of the policy, but we help companies no matter what. We'll help you.
Gotcha.
1 to 5 million per sale, or 1 to 5 million all
1 to 5 million in annual sales.
Oh, okay.
Okay. Most of the policies are bigger than 5 million in annual sales, but look, we'll help somebody at 1 million in sales just because in hopes that we can help them grow to a $10 million company.
Does does the policy, I say I got a guy with 5 million in sales and he sells, I don't know, a dozen things a month or whatever. Does the credit insurance apply to all of those individual transactions, or do you buy it for just one transaction?
There's a number of different kinds of structures, and you can structure it within reason. That's a long conversation, but you can have the credit insurance company approve all your customers, or just a key accounts policy that has to have at least 10 buyers on it, customers, or all your accounts. There is no limitation. There's no restriction. We're not good at one-offs, because one-offs are huge risks. We can do it, but it's going to cost a lot more money than a whole turnover policy.
Let me ask this question, gentlemen, because you're bringing up a good point. And in that point is this right here. And this is where the conversation is connecting for me. So when do businesses seek loans? When you think about this particular one, it's one of those things that when I feel like some of these accounts that are net 30, net 60, and also net 90, they have the ability. I think some of the comfortability on making those term limits is the fact that you have a business loan in the back end. And so that way, that you can bridge the gap if something comes about. Do you feel like this is because the banks, it seems like they're getting tighter out there as far as lending is concerned? Is this still, are they putting themselves, is this creating this bankruptcy funnel that we're seeing as well?
I think it's just a risk in the economy. I think you see what people, you know what you're doing. You're not buying everything you used to buy before. So businesses are the same way. I think the banks are being, more restrictive. If it's a bank, I think they're being very, very restrictive. So a lot of folks are turning to asset-based lenders, ABL lenders. They're turning to factoring companies. And several factoring companies will not lend unless there's credit insurance. Either they buy a policy or I offer a policy to the client. They won't lend on receivables. Some of them, the majority of them, won't lend on receivables if there's not credit insurance involved. Now, banks have to have credit insurance if it's an export account. Under the U.S. Charter, they're not allowed to lend on foreign companies under UCC code. However, if it's a Apple in the UK, they can make exceptions, but their auditors are so tough right now. So banks are driving. We're getting a lot of referrals from banks, huge from factors and ABL lenders, asset-based lenders. But yes.
And that's interesting because you said that one of the things that had sparked my interest in your conversation is banks actually want you to have this type of insurance with you because of the risk that's out there, right? So they're just as much so as aware as the risk within these net 30 and next net 60s, right?
Correct. And if you talk to your banker, I was one for 18 years. I can tell you 90% of them don't understand what I do. So put them in touch with me because I'll help them understand it, and I'll help them because I know how to mitigate a bank issue. But here's the thing. You think about it. You're lending money.
Yes.
What's your credit application like? What are you doing to see? Or are you just happy to get the sale? Oh, I've known them. Everybody knows them. We looked them up on the internet. They're great. Do you really know? Because you're almost outsourcing your credit department for the price of indemnity. So not only you get a policy, you get a whole credit department standing behind you for what? 15 grand for a small policy, 10 grand annually. You can't hire somebody for 10 grand to vet your customers. And credit insurance does that for you.
That's very true. And so, Joe, you've been in the marketplace enough to actually see and I want you to take your lender's eye when I ask this question. As the lender, when you see some of the business operations, when people are offering these net 30, net 60, and you understand it's a relationship business, you understand that you're doing it to create the sale, create the opportunity for you and your business and to keep things going. Do you feel like that's an old way of doing business? Do you feel like they should do away with that in a sense? Or is this necessary just based on your ticket sale?
I think that bankers are so scared of the regulators. Remember, a credit guy never got fired for saying no. So they're getting a lot more restrictive because no's easy.
Right.
You don't get canned for no, you get canned for yes. Okay.
That's true.
So what I'm seeing is people not understanding what they're really offering. You're unsecured. You're at the end of the line. That your customer goes bankrupt. The bank gets paid. That's UCC2 filed first. The companies that UCC1 inventory file, Uniform Commercial Code, the business law of the United States, the security position that they file with the state that they're in. It's all business law. It's all UCC law. You have nothing. So everybody gets paid, and then you sit there for pittance afterwards, and you get paid whatever's less, because guess what? The bank used your outstandings to pay them, because that receivable from what they sold to you, what you sold to them, is paying off the bank loan and paying off the other UCC filers, and you have no power. The credit insurance companies solve that whole problem for you, because they say, okay, we'll take the risk. You're unsecured. You pay us some premium. We'll take that risk. Banks are extremely unorganized, dangerous, consolidating, especially if you're an SME company. Okay. They'll shut you down.
Yeah.
We're getting a lot of calls like that. Hey, I got a call from the bank. They said they don't want us anymore.
You can't do anything about it.
No. And when I was at B of A, they said, okay, we're not doing towing trucks for gas stations anymore. Go and tell all your customers they're out of here. And guess what? So guys with $2, $3, $4 million in their account,
yes,
we said goodbye. And then, of course, 3 years later, they want them back. Well, business owners aren't stupid. They know, they have long memories. So you got to be really careful and protect yourself right now.
And that is true. And this is not to bash banks. I want to make sure I'm clear in my statement here. But banks do have that leverage where if they see a risk after providing some loans, they will drop the credit, or they'll drop the loan amount, right? It can go from 50 to 10,000 or 100,000 to, 50,000 or something like that overnight almost, if they see some kind of risk there, right? And so that can mess up your stability in your operations.
Well, they have you. They own you. Okay. They do and they don't. Okay. But when they control your business and they're washing your account out of your funds and deciding where things are going and controlling you, then they make it a bit of a chokehold. Now, they're not going to do stupid things, but they're going to protect themselves first, not you. And you need to protect you.
That's right. Okay. Well, let's move on to the next point, because I know this is extremely good information. What is the severity of non-payment? It almost seems like it's obvious, but you have started to talk about the domino effect.
Yeah.
And so talk about the domino effect in that business owner and where they started off with working with X client. Everything business is good. It's been going well for a year. They've been on net 60 for a while. The relationship is established. It's almost, and that's what's weird to me. And I know this is how relationships do work. You have a relationship for a year and you have that net 60 and everything's been going good. It almost becomes an insult if you ask them to speed up that payment, right?
Yes.
So talk to me about that domino effect and what the risk is, obviously, besides bankruptcy of this non-payment.
The domino effect. What happens is you get paid until you don't get paid.
Yes.
And when you don't get paid, everybody goes, but I always got paid. and then you're working from arrears instead of being proactive. And what happens in the domino effect is their customer might have, best way to learn is from a story. Had a policyholder of a new prospect, went in, had $1 million in outstandings. He was a food distributor to a company in Hong Kong. And he said to me, my father has done business with this guy for 20 years. We've been doing business for 20 years, but it's a concentration. I need protection. We go to the credit insurance companies and we, free of charge, when you first look at it, you don't pay until you accept it. And they underwrote the buyer and said, we can't approve this buyer for $1 million because they invested in the Hong Kong real estate market with crash last year. Now, mind you, this was 20 years ago, okay?
Sure.
But the point being is the guy went, uh-oh. He was getting paid on time, but then again, he gets paid. When he doesn't get paid, he doesn't get paid.
That's
so
right.
What it did is it gave him a heads up to work through that. In other words, he reduced his exposure with that one customer and change, because it's not a matter of loyalty.
Yeah.
It's a matter of doing the right thing. And the right thing is to protect you, protect your family, and protect your business.
But that's you're bringing up a good point here, Joe, because that word loyalty, the word loyalty makes you go to sleep.
Yes, it does.
Because it makes you feel cozy, makes you feel comfortable.
Yes,
I can call them right now and say, you know what, stop. Go ahead and send them some money, right?
Yes.
So you're doing that in your brain. So now this is where that net 30 becomes net 80 all of a sudden.
Okay.
And then you're paying for arrears because now this client has, because the relationship is so deep,
right?
They think, oh, I can press this out because they know I'm going through a tough time, but they know I'll pay them because of our history.
Correct.
Right. So no longer are you you're falling asleep on your business model. No longer are you caring about keeping it tight and lean and structured on that net 30 and looking at it as a risk. You're thinking it's okay. So now you in your business model, you have the ability to actually look at these clients and actually say, hey, this is actually your risk because of XYZ. Right. Is that very helpful for people to actually understand that?
You wouldn't believe it's credit insurance is black and white. Does the financials or the credit report, depending on size, support the credit limit you're providing or you need? Does it support it? If the facts don't support it, then you're going to get the news. and let me tell you, knowing is better than not knowing. Not knowing is a fool with the blindfold on. No, if you know, then you can make adjustments in your business.
Yes.
One of the biggest things in the industry of banking right now, and it's starting to bleed to everybody else, it's called KOC.
Okay.
Know your customer. KYC, sorry. KYC, know your customer. So your scenario that you gave, what's just happened a month ago.
Gotcha.
The customer was with them forever and ever, and they asked for a line increase to $1 million. So for $1 million, they got to get the financials. I don't know why the customer sent us the financials, because I know how to read financials. It's not your father's company. It's not your father's customer. All of a sudden, guess what happened? Know your customer, KYC. A venture capital company bought the company, and he paid the previous owners out of goodwill, so the tangible net worth of the company was underwater. The debt to tangible net worth was underwater. The cash flow was negative, because think about what a VC thinks about. They're thinking about selling that company or going public. They don't care about, and they use the vendor's free financing to get everything that they want, so they don't have to borrow from a bank. And guess what? If that company went bankrupt, the VC has no direct legal responsibility to pay that debt. Our customer found out because of us. Yes. And they went to their customer and said, I need $1 million letter of credit. And he said, what? Nobody else is making us do that, because guess what? All the other vendors had no idea, but the risk is there.
Yes.
The risk is there. And he gave the money because he needs the product.
That's right. That's right. And that's the point of this. Nobody knows what's going on behind the scenes. Anything can change. And that's where, just as people, we have a tendency to consider yesterday as it is going to be today.
Yeah.
Things can change today and tomorrow. Right. So let me ask this question, because you're bringing us some really good points. I appreciate it.
Sure.
And so what is the confidence of collecting your AR? Is that really the question every business owner should go in with when they're working with any of their clients and trying to obtain a new client going forward?
I think two things. One, that you should do an annual credit risk review. Okay? Annually. Okay. And it could be a lot, it could be a little. You make that decision, and you do it by risk. Are you gonna go crazy over a $10,000 exposure? Probably not. But so you'll do just a little bit of stuff. Even before that, you're going to look at your AR aging summary once a month. And if your terms are net 30, how many people are pushing you past net 30? You should be looking at you should be pulling that at the end of every month. And if we're finding this, which just fascinates the heck out of me. Why aren't you, when they're 1 day late, on the phone, or 2 days before they have to pay? Hey, we got an invoice due tomorrow. 2 days late. Hey, you didn't pay us. And if they start getting 30 days late, the conversation changes.
That's right.
Because out of sight and out of mind is not a business plan.
That's right.
And think about it. Think about it's one of your biggest assets, probably your biggest, is your second line item on your balance sheet. Cash is number one. A lot of people don't have the first line item. Number two is your accounts receivable. It's probably the biggest asset you have, unless you own property or something like that. It's huge.
Yep, that is so true. And Rick, did you want to share something?
Yeah, I had a question. I keep freezing. I'm going, sorry, guys.
No worries.
What was my question now? I forgot already. Oh, I know what it was. The reason people don't pick up the phone like they should is they're scared of their customers. Oh, God, I don't want to make the guy mad at me. But, you've got clientele. You got to keep your clientele, and they should appreciate the fact, hey,
sure,
I owe this guy money. What? It's not a bad thing for him to be calling. It shows me that he's actually paying attention to his business. Right. He knows what's going on.
Well, the beginning conversations are pleasant, right? They're not, hey, your invoice is due up, and you're not talking to the owner, you're talking to the AP person. So, but now it's harder to get a hold of people. People don't answer their phone, right? And it's usually their cell phone, and a lot of people's emails go into spam. So, that's why it's so critical to KYC, know your customer. Don't wait until you have a problem.
I would assume it's a red flag when you've been dealing with a customer for years and years and years. He's been net 30, net 60 or whatever. And he says, hey, on this shipment, can we push it out to net 90 or whatever? That's probably an indication that things are tight for him.
It could be, but it also says some people sell for the holidays, right? And so for Christmas, they say, I'll buy 10 times the normal amount I buy, but can I have longer terms? Well, you pull out the credit application that you have on file and you go, can he handle 90-day terms? Or am I going to be holding the bag 90 days from now? Okay. So it all depends on knowing your customer and what they can do.
Okay.
Part of that is, fellas, is when you think about that, you probably have the infrastructure where if that's where you're putting your net 30, net 60, you probably have the infrastructure of yourself that you have employees. You have overhead. You have something else going on behind the scenes. So it's one of those, you even have to include, can you afford that term? Can you afford that without the assurance? So when it's interesting because in this show, we're talking about you have an opportunity to potentially insure that net 30, to insure the net 60, to insure the net 90. But right now, if you don't have that, you're telling us, and you're saying, without saying it, that you have the ability to take that risk. I want everybody to really understand that this is a weird moment here, where this is a what are you doing in your business model moment. That's what it feels like to me, Joe. Am I?
No, I think you're right on it. It's part of it. The likelihood that your building's going to burn down is much less than the likelihood of somebody you're giving your product to not paying you, and nothing is static. We got an election coming up. Things are going to change. Either way, it doesn't matter. So and everything. Look at the hurricane. Credit insurance doesn't cover natural disasters. However, if the natural disaster threw the customer into bankruptcy, then we have a claim. Okay. But that we got to be specific about that. What we're finding is there's some reasons people really look at it. Exports, high growth, a lot of new customers, concentrations kill. No two ways about it. Concentrations will kill you. They'll take your lights out. Bank financing. Those are and just being able to sleep at night. So things change, and we help, because look, in the old days, companies had an AR manager, a treasurer, a controller, a CFO, and an owner. Now companies have an owner, and the owner's doing all like 1, 2, 3, 4, 5, and they're trying to grow sales. So outsource it. Just let us take care of it for you. And if the only reason credit insurance doesn't pay is for disputes, but we even help you. You can take them to court, and if the court finds in your favor, credit insurance will pay the claim. So we pay for any reason you don't get paid.
Gotcha. Joe, you gave us, you provided some valuable information. I want to appreciate you for taking the time to do that. Is there any final thoughts that you want to leave the audience with going forward?
A lot of folks want to save right now, and they're worried about spending too much. And I would say to you, a fundamental portion of your business, if you sell on terms, is to protect your unsecured loan to someone. Would you give your brother or your sister an unsecured $2 million loan? Probably not. So you can use credit insurance to vet your customers, monitor your customers, grow your business, solve your concentrations, help you export. And it's a good way to help you sleep at night. So it doesn't cost you anything to look at it, and I'll help you. Okay? So take a look. See if there's value.
Absolutely. Absolutely. So, Rick, did you have anything that you wanted to leave the studio audience with today?
Yeah. Be aware of what people owe you and be on top of it. And credit insurance is an excellent idea. How many guys do you employ with baseball bats to go out there and collect from those guys?
The carriers do that, but you know what's the whole thing is just, it's all old. Credit insurance been around since the 1800s.
Wow.
In Europe and Western Europe, almost 70% of companies credit insure. In the United States, we're a bit of a cowboys. But they're starting to do it much, much more because they don't want to worry about this anymore. So no, it's all legal stuff. There's no beating up.
Started up with Lloyd's of London when they started insuring the ships sailing over to the New World.
That's right, because it was out of Maryland. So the two biggest ones are located in Maryland, and the third one's a little north of Maryland. So yeah, the 1800s is when it started. So it's been around a long time.
Awesome. Gentlemen, I appreciate both of you, Rick, always with your insight and thank you for always being aware as to what's going on and keep on exposing the business owners to other products within the marketplace to help them grow their business and protect their business. Most importantly, Joe, everything that you do and your passion behind protecting businesses and keeping them steady and the message that you want to get across. We look forward to having you on in a few more months to talk about some other topics that are important. So thank you both. We'll see you next time, gentlemen.
My pleasure. Thank you both.
Thank you.
Bye-bye.
All right. So for the rest of you that are watching and that will be watching the show later on and listening on our podcast, thank you so much for taking your time out of your schedule. I want you to take a minute and think about what Joe is really honing in on. Protect your business. If nothing else, look into your business model. Look into that net 30, look into that net 60, look into that net 90. If you have employees, you're responsible for a whole lot of people. If it's just you, you're responsible for you and your family. And so if you're actively doing business, you're in the middle of trade, make sure that your trade and your asset is protected, which is that deal, which is what you're working with. We're in the day and age where loyalty, those things still exist, but things are a little bit different now. We want to make sure that everything is clean, make sure that loyalty, make sure that relationship with your client remains strong, and that money is not the issue within that relationship. So if there's that protection out there in the marketplace that can help you keep your business going and still keep that relationship, that's what we want to hear and introduce to you as far as what you can do for your business. So I want to thank everybody for taking a look at today's segment. But in the meantime, Joe, myself, and Rick and I, we actually have to get back to work. So we'll see you next time. Have a good day.